History's biggest financial disasters never strike without warning. Long before a crash becomes a headline, long before markets melt down in real time, the smartest people in the room have already moved. They've already sold. They've already hedged. They've already positioned themselves for what the public still believes is impossible. Every major collapse follows the same choreography, a familiar rhythm playing quietly beneath the noise of optimism and euphoria. And in 2025, that rhythm is beating again, steady, unmistakable, and eerily similar to the patterns that preceded 1929 and 2008. This isn't about doomsday predictions. It's about recognizing behaviors that repeat with almost scientific consistency. Because the people who understand the mechanics of markets, the ones who actually study cycles, leverage, credit flows, and risk premiums, are once again making the same moves they made before every historic downturn. The questions are simple. Why now? Who's moving? And what does it mean for the rest of us? Let's break down the pattern, stage by stage, and look at what the smartest investors in the world are doing in 2025 while almost no one is paying attention. In 1929, Joseph Kennedy stepped out of the market roughly half a year before the crash ripped through Wall Street, and then multiplied his fortune by shorting the chaos that followed. In 2008, Michael Burry famously bet against subprime mortgages and walked away with $700 million. John Paulson made even more, cementing his trade as one of the greatest in history. And now, in 2025, the financial world is watching the same setup form again. The same sequence. The same investor behavior. The same calm before a familiar storm. There's a pattern embedded in market history, one that surfaces whenever valuations reach absurd extremes. It's not luck, and it's certainly not coincidence. It's a four-stage system that sophisticated investors follow with almost eerie discipline. While everyday retail investors cling to their stocks, praying for dips to bounce, a much smaller, quieter group positions themselves to profit from the coming downturn. These people don't cause the crashes. They simply read the writing on the wall long before anyone else notices it's there. They act early, step aside quietly, and prepare for the inevitable. And whether we look at 1929, 2008, or right now in 2025, the pattern is identical. In 2025, Warren Buffett is sitting on a record-breaking $325 billion in cash, the largest cash pile ever assembled by a single investor in modern markets. Jeff Bezos has sold over $13 billion worth of Amazon shares in the span of roughly a year. Mark Zuckerberg has unloaded billions in Meta stock even as the company hit new highs. Jamie Dimon, who almost never sells, reduced his JP Morgan stake for the first time in his career. Corporate insiders across the United States are selling shares at levels not seen since 2007. Back then it was a quiet warning. A year later, the global financial system nearly collapsed. And behind the scenes, a small group of hedge funds are quietly stacking positions that only make money if markets fall, massively. These aren't rumors or speculation. These trades are listed in public filings: put options, volatility instruments, credit insurance. They're all right there for anyone who knows where to look. This isn't a conspiracy theory. It's documented strategy. And it follows the same four-stage blueprint we saw in the crashes of the past century. So let's break down each stage: how it worked in 1929, how it repeated in 2008, and how it's beginning to unfold again today. Stage 1 is when the professionals step aside. This phase usually begins long before the public senses any danger. While markets are still rising, optimism is high, and headlines are filled with bullish predictions. Sophisticated investors don't exit because they know the exact date of a crash. No one does. They exit because valuations reach a point where the downside dwarfs the potential upside. The math no longer makes sense. The risk-reward balance flips. Let's see how this unfolded in 1929. Joseph Kennedy was one of the most dominant speculators of the roaring 1920s. He made millions participating in stock pools, coordinated efforts by insiders to drive up prices. But by mid-1929, while the party was still raging, Kennedy began selling. The famous story says he decided to exit after receiving stock tips from a shoeshine boy. If even the shoeshine boys were speculating, he reasoned, the top must be near. It's a colorful anecdote, but the truth is more calculated. Kennedy was obsessed with leverage. By 1929, margin debt had exploded. Investors were borrowing up to 90% to buy stocks. He understood that if prices dipped even 10%, lenders would demand repayment, forcing mass liquidation and triggering a cascade of panic. Bernard Baruch, another legendary investor, saw the same warning signs. He had lived through earlier panics and recognized the smell of excessive speculation. By the fall of 1929, both Kennedy and Baruch were out. The Dow hit its peak on September 3, 1929. 7 weeks later, Black Thursday marked the beginning of the worst crash in American history. Kennedy and Baruch had already locked in their profits. Now fast forward to 2008. Michael Burry began studying mortgage data in 2005. He realized that millions of borrowers would default once their teaser rates reset. The loans were toxic yet magically rated AAA. John Paulson ran similar analyses and reached the same conclusion. For nearly 2 years, both men endured ridicule, angry investors, and monthly losses as the housing market climbed. But they stayed disciplined. Because stage 1 isn't about timing the crash, it's about exiting the bubble and positioning before everyone else wakes up. The housing bubble peaked in 2006. Defaults exploded in 2007. The crash followed in 2008. Now 2025. Who is quietly exiting today? Warren Buffett, record cash, almost no new investments. Jeff Bezos, massive Amazon stock liquidation. Mark Zuckerberg, billions in Meta stock sold. Jamie Dimon, selling for the first time in decades. Corporate insiders nationwide, highest selling since 2007. Buffett indicator, a dangerous 185%. Stage 1 is underway. The smart money is already outside the blast zone. Stage 2 is when sophisticated investors prepare not just to avoid losses, but to profit from the downturn itself. In modern markets, this means buying volatility instruments. Put options, VIX calls, credit default swaps, sector-specific hedges. Stage 2 is always executed before the crash becomes visible. It's the moment when insurance is cheap because everyone else still feels safe. In 1929, volatility insurance meant shorting stocks. Kennedy and Baruch paid borrowing costs while prices rose, but when the crash hit, their positions exploded. In 2008, Burry and Paulson bought credit default swaps on mortgage bonds. They paid premiums for years. Their investors panicked. Some tried to pull out. But once defaults began, those same swaps paid hundreds of millions. Paulson's fund earned $15 billion. In 2020, Bill Ackman bought credit insurance during the first rumblings of COVID. He spent $27 million. Weeks later, the payout was $2.6 billion. Now look at 2025. Put option volume is surging. The put-call ratio is elevated for months on end. Institutions are buying VIX calls that only pay if volatility explodes. Credit default swaps on commercial real estate have risen 300–500%. Office vacancies hovering at 40–50%. Loans maturing at rates no one can refinance. Defaults mathematically unavoidable. Someone is buying this insurance for a reason. This is stage 2 in motion. In 2008, stage 3 was where Michael Burry, John Paulson, and a handful of others made their legendary fortunes. They didn't simply bet against housing, they identified the exact slices of mortgage bonds that were mathematically guaranteed to fail. Burry dove into loan-level data and found the worst of the worst. Subprime loans flooding Florida, California, Arizona, and Nevada, where speculation had overheated the fastest. Adjustable-rate mortgages that would reset in 2007 and 2008, trapping borrowers in payments they could never meet. He shorted those precise tranches. When defaults surged, those bonds didn't just fall, they went to zero. His credit default swaps paid out at maximum value. Paulson followed a similar path, shorting not only mortgage bonds but the institutions that held mountains of them. In 2007 and early 2008, months before the public realized anything was wrong, Paulson shorted Lehman Brothers, Bear Stearns, and Washington Mutual. These trades were wildly unpopular. Analysts rated these stocks as buys, insisting the firms were too large, too important, too interconnected to fail. But Paulson had studied their balance sheets. He saw what most didn't. The assets on their books, mortgage securities, were worth far less than the liabilities they owed. These firms were insolvent long before regulators admitted it. When Bear Stearns collapsed in March 2008, Paulson made a fortune. The stock plunged from over $100 to $2. When Lehman went bankrupt that September, shareholders were wiped out, but Paulson's short positions produced billions. From 2007 to 2009, his funds earned roughly $28 billion. Most of that came from stage 3, precision targeted shorts on the weakest links. Now let's jump to 2025 because stage 3 is unfolding again, and the targets are just as obvious to those looking closely. The first flashing red sector is commercial real estate. Offices across the US sit half empty as remote work becomes permanent. Companies that once leased entire floors now rent a single space. Buildings financed at 3% interest must now be refinanced at 7-9%. The math doesn't work. Properties that barely broke even before are now underwater. Values in major cities, San Francisco, New York, Chicago, Los Angeles, have already dropped 40-60%. And when these loans mature, many owners won't refinance. They'll simply walk away. It's already started. In 2024, Brookfield, one of the world's largest real estate firms, defaulted on 2 major Los Angeles towers, handing the keys back to lenders. Not because Brookfield was failing, but because the buildings were worth less than the debt attached to them. Between 2025 and 2026, over $2 trillion in commercial mortgages come due. A significant share will default. And who holds much of this debt? Regional banks. This is the second major short target of 2025. Regional banks with high exposure to collapsing commercial real estate. We've already seen the preview. Silicon Valley Bank failed in March 2023. Signature Bank collapsed days later. First Republic went under in May 2023. New York Community Bank nearly failed in early 2024. And this happened without a recession, simply because interest rates rose faster than banks could adjust. But now, a second wave is forming, driven not by long-term bonds but by commercial mortgage losses. Unlike big banks, where commercial real estate is a small slice of the portfolio, regional banks often hold 20-40% of their total loans in this sector. When office buildings default, these banks will be forced to write down enormous losses. If those losses eat through their capital, regulators will shut them down. Hedge funds know exactly which banks are most vulnerable. This data is public through quarterly filings. They know which regions have the highest office vacancies, which banks have the largest commercial real estate exposure, and which balance sheets are too thin to survive a wave of defaults. Short interest in these banks has surged. Major funds are positioning for failures, not because they want banks to collapse, but because the math already says many will. Regulators and politicians sometimes blame short sellers for bank runs, but that logic is backwards. Short sellers don't create insolvency, they recognize it before the public does. This is stage 3 playing out in real time. Target the weakest sectors, the weakest companies, the weakest balance sheets. Not shorting the whole market. Not making vague macro bets. But precision-guided shorts aimed directly at the first dominoes. The smart money is already positioned. Short commercial mortgage-backed securities. Short regional banks with extreme real estate exposure. Long volatility. Holding massive cash reserves. They're paying borrowing costs to maintain these positions just like Burry and Paulson did. And they're waiting for the moment when defaults increase, regional banks start to fall, and these trades explode in value. Because once commercial real estate defaults cascade through late 2025 and 2026, and once regional banks start failing in clusters, stage 3 will pay out exactly the way it did in 2008. And that leads to the final, most powerful part of the cycle. Stage 4, buy at maximum fear. The moment when the world panics. And the smart money begins buying everything.